you wondering why everyone's been talking about interest rates and how that first recent cut changes your life and the markets? The Federal Reserve just cut its policy rate by a quarter of percent, bringing the Fed's fund range to about 4 to 4.25%. The first cut since late 2024, and hinted more may be coming if growth and jobs continue to soften. Variable rate debt is where you'll feel it first. So credit cards, HELOCs, these can adjust with a billing cycle or two, so interest costs may ease slightly. But don't expect miracles from a single cut. Most US mortgages are fixed, so existing loans for those people won't change. New mortgage rates follow longer-term bond yields more than the Fed directly. If markets expect more cuts, mortgage rates can drift down, improving affordability a bit and supporting housing activity. Rate cuts pressure yields on savings accounts, money markets, and CDs. That cushy 4% might trend lower, so parking big piles of cash could earn less over time. Cheaper borrowing lowers companies' financing costs, which can help hiring and investment. This is one reason that the Fed will cut when the labor market shows signs of cooling off. Lower rates generally boost stock valuations by making future profits worth more and by nudging investors out of cash. Markets often rally on cut expectations, though leadership can rotate and volatility is normal. When rates fall, existing bonds with higher coupons become more valuable, so bond prices rise. If cuts continue, longer duration bonds usually benefit more, but they'll also be more sensitive to surprises. Rate relief can help real estate by lowering financing costs and stabilizing cap rates, but fundamentals, rents, vacancies, local supply still drive most returns. When real yields fall and policy eases, some investors reach for alternatives like gold or crypto, and that's not guaranteed, but we have seen very strong interest in these assets over the recent few years. In fact, gold and Bitcoin are rallying a lot as I'm making this video right now, and I myself am a pretty big investor in Bitcoin. So what to do now? Some practical moves would be paying down variable rate debt first, shopping lenders if you have a HELOC or plan to refinance, and don't overpark in cash if yields slide down. Make sure your bond mix matches your time horizon, and for stocks, stay diversified. Cuts can change sector winners. The bottom line, rate cuts ripple from your credit card to Wall Street. One cut won't transform everything, but if the easing cycle continues, borrowing gets cheaper, cash yields dip, bonds usually rally, and stocks often get a tailwind. Thanks for watching this video. If you found this helpful, go ahead and subscribe and like the video.